How to be a successful investor. There are two simple rules you need to follow. The very first one, don't lose money. The second rule is, don't forget the first rule. Thank you, Warren. So the idea is that whenever market is underperforming, you keep investing. On the long term, the market is always growing. Hello everyone, my name is Alex. Welcome to Investment Journey. I hope you're staying safe. I hope you're doing well. So what are we going to talk about today is how to be a successful investor. What are the rules? What are the principles there? And what I follow and what I think is the most important thing to know about being an investor. We're going to consult with our friend Warren Buffett. We're going to look at different media articles that popped out here and there, and we're going to see what are other things you need to worry about or you need to look at whenever you're building your investment portfolio. 5 core principles of being a successful investor. Not a trader, an investor. There's a huge difference between those. And these 5 core principles are not specifically aligned on any priorities. You need to look at all of those at the same time. You don't need to prioritize any of those higher than the other one. And the very first one is study the business, not the stock price. What it means is that a lot of investors, they look in the stock price and they predict and think that, okay, tomorrow or next year or next month, the stock price is going to be $20 instead of it being today $10. And it's one way to do it. But what I think is more important is actually the business that this company is in. And I got this one from our very good friend, Warren Buffett. One of the best, actually I think the best investor of all time and one of the wealthiest people on earth. You need to look at what the business is doing, what their balance sheets are. If you're not an economist or you're just starting out with investing, one of the good things to look at is the brand. So the brand is something that company builds over time and that people love. It's easy to look at it from the consumer perspective. So when you look at a company that is B2C, business to consumer, so for example, the GoPro, they're a very good brand. Everybody loves them. Everybody likes the cameras they're making. Everybody likes what they're doing and how people are using them and all that. You can see those videos all the time on YouTube or Instagram or anywhere else. Even in the movies, people are using them for shooting some crazy videos during the actual filmmaking, right? Another one would be like Google, right? It's a huge brand. Whenever you want to search something on the internet, you say, can I Google this? Can I Google that? The company built their brand so everyone knows what they're doing. They're on the spot all the time. The second one is use the facts, not be influenced by media. So what it means is that whenever you see an article pops up about the market crash, or prediction for the market crash on one of the top selling magazines like New York Times or Business Insider or Forbes. And that's when emotions overtake you, because this is a big platform, media platform. They're posting this article about that the market is on an all-time highs right now. So they're predicting there's going to be a crash anytime soon. And then you're pulling out, right? And then you're missing out on all the other gains that happened throughout that period of time. But as you can see, the whole 2019 was the best year, and then it only crashed in 2020 just because of this coronavirus thing happened. And even then, you would recover by the end of October or November. So you just need to keep holding and use the facts, not be influenced by all the medias out there. You just need to stay your course and use the facts. If you're not invested yet in the company you're thinking you want to pick, you just need to use the facts and look at their financial data and what they're doing. You can look at the historical data, what happened to those markets during the other crises. For example, in 2008 was the real estate crisis, if the company performed well during that crisis or not. And you also want to be diversified, right? So if you're a lot into financial markets, into banks, and you still want to pick another bank, just wait a second. You need to also invest into other sectors, so your portfolio is diversified, so you can go through all the market crashes or any other market fluctuation in a smooth out fashion, right? So that's important. The other important thing to know about using the facts but not being influenced by the media or any other things is that if you're investing in dividend stocks and you keep holding to your positions, even during the market crash, you keep gonna get your dividends. This is crazy, right? Whenever the market is crashing, you're still getting your dividends. And moreover, this is the great time for you to invest more. You're gonna be higher yield, you're gonna get more dividends back, you're gonna get more free stocks back with your investments. So the third one is only buy things you understand. So if you're building your portfolio, you don't want to have like hundreds and hundreds of stocks under your portfolio, because it's going to be very hard for you to keep track of all the different sectors, all the different stocks and positions you're in. So I would encourage you to have 20, 40, maybe 60 stocks under your portfolio. Then you'll be able to study those in a very good fashion. For example, if we go back to our friend Warren Buffett, he hasn't invested in technology company for a long time because he didn't understand what those companies were doing, right? And that's okay. If you don't understand the sector or specific stock you want to buy, just don't buy it. You can go and use the ETFs. They will have all different companies under the same stock. And that's another good thing about ETFs, so that you don't have to study all the different companies under this ETF. They're gonna shuffle them for you. They have specific rules under them that they're gonna be only holding companies, say, where the dividend yield is higher than 3.5%, right? So you know they're gonna kick out the company if the yield is going down, and they're gonna add another company where the yield is 3.5% or more, based on their rules and requirements. So only buy things you understand. So the first one is more directed into dividend investing and dividend stocks. What you want to look at is for how long this company paid dividends and what is the dividend growth on that company. Most of the good dividend companies are blue chip stocks. It's Coca-Cola, Johnson & Johnson, Microsoft, MMM, QQQ, and all those. So those are the companies where you're sure they're going to pay dividends no matter what. They're going to keep crashing these record numbers where they pay dividends for 30 years, for 40 years. They're not going to just cancel the dividends just because the market dipped for like 30%, which is a crazy number, right? If the market dips to 30% means there's a market crash. But the blue chip companies, they're gonna keep paying dividends. For example, ExxonMobil, they were hit very hard by this market crash, and the stock plummeted by like 50% or something like that. But it's important they keep paying dividends. So if you held ExxonMobil before the market crash, and then the market suddenly crashed, so you're still getting those dividends. You're not affected by this crash. So that's important when you pick dividend stocks. Just look at these blue chip stocks and see what happened to the dividends throughout the years. Another important thing about the dividend investing is you want to look at the ETFs as well. So I keep talking about the ETFs because I think it's very important to look at. And there are a lot of good ETFs. There are a lot of recent ETFs that were just added. Things like high dividend ETFs or dividend growth potential ETFs and all that. So want to check out those too if you want to be in dividend investing like I am. And the fifth one and the very last one is that don't overcomplicate investing. And what it means that investing is boring, and that's okay. It doesn't have to be a roller coaster. Just keep holding, don't trust the media, don't pull out, stay the course, get those dividends, sleep and wait to get paid, and diversification is gonna smooth out everything on the long run. And that's my 5 core principles on how I pick stocks, how I look at investing in general. And I know it maybe doesn't sound like a 1, 2, 3 rules on how to pick specific stock. I hope these rules are valuable to you. I hope you're gonna follow them, or you're gonna add more on top of those, because you do you follow what you're comfortable with. And you build your strategies. Let me know in comments, what are your strategies? What do you think is important of being an investor? Thank you for stopping by. Thank you for watching until this. Like this video, subscribe to my channel, and I'll see you in my next video. Bye.